Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Pavitra Parekh, and it's turning out to be a quiet session. The markets opened absolutely flat. But since then, there has been a bit of a pickup in the markets. We're currently up close to about 67 points on the Nifty. The Sensex has gained more than 200 points. But in the last 10 minutes, there has been a bit of a slip from the top. All in all, you would still call this session fairly lackluster. It's the last 2 weeks to wrap up what's been 2022, a very volatile year. We've seen swings in either way. But now, as we enter into the last phase of this calendar year, things generally tend to die down. Volumes too, participation from institutional investors as well slows down. Talking about the big winners, Bharti Airtel is the top Nifty gainer. That's rallied close to about 2% M&M and Eicher Motors. These are the two auto names which are on the front foot, so accelerating a bit. M&M has gained 1.8%. Strength coming in on Bajaj Auto. Bajaj Auto is currently up close to about 1.5%. So autos are driving some of the gains today. On the losing side, you've got cuts coming in on oil and gas names. So BPCL, ONGC under pressure. IT names led by Infosys is seeing weakness following Accenture's cautious management commentary, where they are indicating that client spends are moderating. Smaller size deal wins are also seeing some amount of slowdown. And if you just look at the guidance provided by Accenture, it implies that things will slow down in the second half of the year, growth rates. And that's something the street is fearing will happen even in the Indian IT space. So Indian IT stocks are a bit on the back foot. Hi.
Hi, good morning. Like you said, it is a bit of a slow day and things are likely to be slow till the end of the year. But if you want to feel better about yourself, let's take a look at what's going on for the rest of Asia. It's really not looking good. The Hang Seng markets, Nikkei, Taiwan, across the board, you're seeing significant cuts come through. So I guess in that broader context, we're still holding up quite well. What's also doing well for our own markets today is the consumption pack. So a few of those stocks will be up on your screen. The sugar stocks are just out of control, and this is after the kind of move that we saw on Friday. So take a look at a few of the kind of gains that you're seeing on Rajshri, Simbhaoli. These are just a few of the names, but pretty much that entire space is buzzing around. Nifty IT, like Reema was pointing out, for the week of okay, this is the rate today, but if you take a look at what's happened for the past 1 month, it's seen a near 7% cut on the IT index. Do keep that on your radar. And today, the PSU banks, after that strong rally, coming under a bit of pressure, but not too many cues for us to work with. So let's see how the trading session pans out. But before that, let me run you through everything that we have lined up for you on the show today. Stocks trade ranged ahead of Christmas. FMCG stocks clock in some gains while IT drags. Mid-caps outperform. We'll discuss the way forward for the market with Devang Mehta of Centrum Wealth Management. Investor solutions provider KFin Technologies' 1,500 crore rupee IPO opens for subscription today. Shrikant Nadella, whole-time director and chief executive officer of the company, will be joining us to discuss the outlook for the company. And outsourcing giant Accenture maintains its FY23 guidance in constant currency terms despite reporting a strong Q1 with revenue growth ahead of guidance. What does this really mean for Indian IT? We'll discuss the outlook with Aniket Pandey of ICICI Securities. And from our special series, Medicine Box, we will also get you key excerpts from an exclusive conversation with Dr. Naresh Trehan of Medanta. So all of this and lots more lined up for you over the next 60 minutes.
Even as the secondary market action dries down, the primary market continues to hot up. Investor solutions provider, largely to the mutual fund AMC space, KFin Technologies IPO has opened up for subscription. It's a large IPO, 1,500 crores is the fund size, is the amount they're looking to raise, but it's a pure offer for sale. Surbi is joining in to tell us all that you need to know about this financial services platform and what their offerings are and financials are. Surbi?
KFin Technologies will launch its IPO today and the offer will end on 21st of December. The price band will be in the range of 347 to 366 rupees per share. The issue size is nearly 1,500 crores, which is entirely an offer for sale issue, so no money is going into the company. The implied market cap will be close to 6,100 crores. General Atlantic Singapore will sell close to 25% stake in the company, and post the IPO, they will continue to hold close to 29%. Now, what does the company do? It is the largest investor solutions provider to asset managers like mutual funds, AIF, wealth managers, and corporate issuers. It holds a market share of nearly 59%. They earn their revenues primarily through a percentage of AUM they service. They also get transaction-based revenue or a fixed fee for the number of AMC branches they service, and also receive a fee for IT services. 90% of their revenue comes from domestic mutual funds. For the first half of FY23, they had an average AUM of close to 12,30,000 rupees with an equity AUM market share of nearly 35%. Their revenue for the first half was 349 crores with an EBITDA margin of close to 38% and a PAT of 86 crores. Now, there is only one listed peer in this space, which is CAMS, and it is trading at close to 39 times FY22 PE. KFin is going to come in at 41 times FY22 PE, so slightly more expensive than CAMS.
All right, Surbhi, thanks a lot for taking us through all of the details of the company. We're also joined by Shrikant Nadella, whole-time Director and Chief Executive Officer of KFin Technologies. He's here in our studios. Shrikant, thank you very much for joining us. I'm Pavitra. And, it's good to have you here in the studios. And congratulations on the IPO opening. We just heard it from Surbhi, but, if you could take us through a little bit about the workings of the business as well. We do know CAMS is listed and is a direct payer, but if you could tell us about your business model as well.
Thank you so much, Pavitra. Thank you, Rima, for having me over. And very good day and, welcome to all your viewers. KFin Tech is a leading platform-based solution provider for the capital market space, right? I mean, it's a company that's been in existence for a little over 37 years. We are one of the two players in the market who provide the solutions and services to all the mutual fund, companies in our country, the asset management companies. We are also the only, qualified registrar and transfer agent who operate both on the investor solutions as well as on the issuer solutions, issuer here being the corporate. Incidentally, not just this, we are also one of the central record-keeping agent to administer the national pension system. We also are present in India and deliver to the clients based in Malaysia, Philippines, Hong Kong, and soon to start in Singapore as well.
Can you tell us the key differences between your business model and CAMS for the benefit of our viewers? And also you were telling us that you have a higher or a majority share of the clients, but your AUM is smaller than CAMS. Why is that?
Sure. KFin and CAMS, so we operate in the similar space. As I said, both of us are called the qualified registrar and transfer agent. CAMS, we compete with them in the case of the mutual funds. We are also present in the issuer solutions, where there is an unlisted peer called LinkedIn Time. We compete with them. But in terms of other lines of businesses, we are differentiated because we are the only player who operate beyond boundaries. As I said, we have international presence. We have clientele based in Malaysia, Hong Kong, Singapore, and Philippines. We are also one of the at-scale, national pension system provider. We command a little over 5% of the market share today. Manage a little over 300 plus alternate investment funds that exist in the country out of the total base of 800. We're also differentiated because we also manage a certain amount of mortgage book for one of the largest mortgage player based in the US and Europe. So we're differentiated from that point.
International presence, alternate investment funds, which includes pension as well as mortgage.
Pensions, yes.
That's the key difference.
I know. So CAMS is also present in pensions. They just got the license to administer the national pension system, but we've been there for a little while longer.
Okay. And the difference between why your AUM is a lot small and the market share and the trends that we're seeing on that front?
See, based on the CRISIL report, KFin Tech's market share in terms of the asset management companies is today about 59%. So that basically translates to 24 out of 41 asset management companies in the country work with us. Yeah. As far as the AUM is concerned, that is a factor of how large our clientele are and how fast they've been growing. Historically, many of the bank-based asset management companies, have been with CAMS and they continue to grow. But if you see over the last 4 years, the trajectory and the velocity of the growth had largely been from that of the KFin Tech service clients. We have seen market share gains from about 26% to 35% in the case of equity. Okay. We have seen a SIP market share increasing close to 42%. So with the number of asset management companies and a win rate, that tends to add up a market share which continues to expand over a period of time.
All right, got that. I want to ask you about the issue as well because the IPO has opened today. We do know Kotak picked up around 10% in this around a year ago, November of 2021. That was at 185. Today, your issue is priced at almost double of that. Can you tell us what do you think is the key change that has come about in a 1 year period for it to be priced like this?
Sure. So I'd like to believe it's not just a 1 year journey, but then it's a transformation that's architected and probably started about 4.5 years back when General Atlantic Partners came into picture. It's a complete overhaul of the board. An independent board has been put in place. An independent management team led by myself, have been put in place. But when Kotak Mahindra, Bank had come and invested in sub 10%, around that time we have, had certain KPIs we have published in our RHP. I think page number 128 if you look it up. See, at that point in time, we wanted to have a marquee Indian player known for corporate governance standards to come and validate, our governance standards too. Right. At that point in time, the entire due diligence took roughly about a year, and the KMB Bank have seen close to 3/4 of our performance during that period of time. So basically, based on the 2020 financials, right, is how the entire deal eventually got consummated in November 21. The key performance indicators from then to now, if you see, our revenues have grown a little over 50%. Our margins have grown over 37% since then. Market share in mutual funds has substantially increased. International presence expanded. The pensioners in the case of National Pension System moved from about 250,000 to a little over 800,000 plus. So all of these speak about financial performance as well as a pipeline that we've substantially built and, make a significant movement from that.
Yeah.
Can you talk a bit about your margins? FY20 EBITDA margins were 35%. In FY21, it went to 44%. FY22 was 45%. But in the first half of this year, it's dropped to about 38%.
That's correct.
The reason for the drop and the longer term trajectory on margins, and how can you scale it up?
Sure. We've seen a consistent increase in the margins over the past 3 years. That's on the back of a superior run rate in terms of revenue, as well as a lot of automation that we could orchestrate and engineer in terms of our operations as the scale expanded. But it is also important for us to know that we are a company which is fairly diversified. We are very intentful of growing our international business. We are very intentful of growing our tech-based, platform-driven business. Now, all of those need certain investments. For example, in the 6 months that just went by, we have recruited country heads in each of the operating geographies, such as Thailand and Philippines and Malaysia, so on and so forth. So there is a substantial investments being made in terms of the business development, investments going into the technology side and the platform, so that we are not just ready for today, but then for tomorrow. We have also architected and for example, led one of the largest IPOs our country had ever seen, LIC. And we have invested substantial amount of money to provide a market experience to the investors. So apart from those one-off expenses, I'd like to believe the trajectory in terms of profitability, we'd like to believe that we'll be able to maintain something that we've seen in the past.
So what are the margin range? What's the margin range you think you will be?
So we've been range bound, 40 to 45% in the past, right? And we'd like to believe that anything beyond that, if we could accomplish, we would love to plow back in terms of additional, modes for creation for the future. So
long-term margins in a range of 42 to 45%?
Well, if history repeats itself, I think, we're working towards that, yes.
Okay.
Okay, just one final question, because you did mention the international business as well. Right now, it's around a 90-10 split, right? Domestic to international. Where do you see that headed in, say, 5 years?
So international for the period ending September was about 13%, right? And we have made certain acquisitions, not just managing the investor solutions, but also for fund accounting and administration, which also has international presence. We'd like to believe that, over time, we will be present not just in Southeast Asia, but, hopefully in the US and European markets as well. Okay. And we want to orchestrate a revenue pool of probably about 20% in the near term in terms of the overall pool, even as it expands.
So revenue contribution of the international business will rise from the current 13% to 20%?
That's our intent and working towards, so yeah.
By?
Probably about a 3-year horizon.
3-year horizon. And how different are the business dynamics for the domestic business and international business? In terms of margins or in terms of growth rates or headwinds that you see?
See, I think it's on the international, especially on the Asian side, we render similar solutions as we render in India today, which is taking care of the investor side of the book, right? Whether it's asset management or hedge funds or private equity alternatives, so on and so forth. That business is not vastly different in terms of our operations. It is different to the extent that it is mostly orchestrating a win by moving in-house to an outsourced model, right? Largely, it's all in-house at this point in time, unlike in the case of India. That's got its own problems. There's a lot of inertia to move work, but then, we're able to orchestrate. We won about 25 clientele in a matter of 4 years since we started our international operations. But when you move to US and Europe, transfer agency is not a very prevalent business. Out there it is fund accounting and administration. And that's a very exciting business too. A lot of international players are there. It's about a $4 billion business.
Okay, also you've mentioned in your DRHP that you are looking to acquire an account aggregator. Is there anything that's on the anvil immediately, or say by the end of this financial year, something that we can expect soon?
See, we have a board-constituted business development committee, and then, we constantly evaluate a series of options, whether it is in the space of an adjacency or to gain a market access or to expand a book of business. And account aggregation is definitely one of the adjacency we are looking at. We evaluate about 4 or 5 at this point in time, but hopefully, I'll be able to, discuss, sometime later in the future. At this point in time, it's still in discussions.
Okay. So 4 or 5 companies are currently under evaluation, right, for an M&A? due diligence is on?
4 or 5 companies we evaluate at any given point in time, and our appetite had been roughly to about under $10 million in terms of our investment appetite, and typically we've been acquiring about a company or so. We won't be able to acquire 4 in a single year, so probably about 1.
Okay, just one final question. What's the balance sheet strength? Why is it that the company is not raising money? How much cash do you generate to support your investments that you are making to scale up your international presence as well as your M&A plans?
Sure. See, much of our PAT converts into cash. We are an asset-light model. We do not have any, assets except people are our assets, quite honestly. It's just the platforms that we build on top of that. We're sitting on a cash and cash equivalents of about 172 crores for the period ending September 2022. Okay. We did not need further raise for primary for sustaining company's operations. Our international expansion is largely a factor of custom making a platform to fit the local geographical needs, which anyway we expense it out. Outside of that, it's largely just taking the people. So I really don't need capital to expand internationally too.
All right, Srikanth, thank you very much. We're going to leave it at that today, but we do hope to have you back here, and then, we will discuss more about the business as well, probably on listing days when we can speak to you again. But thank you very much for joining us. That is the management of KFin Technologies, talking about the issue details as well as their outlook from here. They do see margins at, pretty much the current range, around 40 to 45% right now, and they are looking at some acquisitions as well. But with that, we have to get into a short break. When we come back, we're going to shift focus from the moon into trading are on CNBC-TV18. The market is moving higher. It's an 80-point gain that we are seeing on the Nifty. In fact, the mid-cap index has also moved comfortably into the green right now. So we're seeing a 0.25% in terms of a gain on the mid-cap index, where it was in the red from, up until 5 minutes ago. So there's definitely a recovery playing through. Like we've been pointing out, it is really the consumption pack which is helping the market today. So there you have the mid-cap index on your screen. We're going to come back to this, but first up, let's talk about the commodity space now. Manisha joins us. Manisha, what are you tracking today?
Well, I'm high on coal right now because we've seen this commodity outperform the overall energy pack and actually most of the other commodities as well. 21% up in the month of December, and we are up nearly 140% in this current year. There have been various reasons for that. I'll come to that. But first of all, the report card for 2022, and we started this year with around $157 per ton, and that has been the low for this year as well. All-time high at $450 per ton. That was in the month of September, and currently trading at around $405 there. But let me tell you that there have been various reasons for the prices to continue to keep firm above $400, majorly because Europe is staring at a shortage of gas for power generation, and coal is clearly being in use there. And then you have India, where we have seen strong demand for thermal coal that has been supporting prices. And apart from that, a lot of mines in Australia have been hit because of the floods there. So names like Glencore, BHP and Anglo American all have talked about lower mining numbers, and that has been supportive. Also, when you look at the IEA report that summarizes 2022 quite well, they say that the global coal demand has hit an all-time highs in this current year. They also talk about the fact that the investments have been on the lower side, and that the coal demand, while it will decline by 2025, but the next couple of years are expected to see higher demand and higher prices going forward there. China, India, Indonesia are some of the countries which have seen best production, record production actually, for the year 2022. Take a look at Russia then, and that's the third largest coal exporter in the world, and we are looking at numbers continuing to decline there. Last year was 174 million tons, this year 160, and the next year could be even lower at 152. But we have strong numbers when you look at the other producers. Indonesia, for example, is the largest when it comes to thermal coal, and we are looking at 432 last year, 438 this year, and the next year can be at as high as 450 million tons as well. Take a look at the prices then, and that is where the divergence really comes in. Fitch Solutions is looking at 280 of an average in the next year, Bank of America at 300, ANZ 361, and an all-time high expectation in sense of prices at $485 per ton is what's coming in from Trading Economics. So it's going to be a choppy, volatile year next year as well, with ranges anywhere between 280 to 485 expected.
And it's a good thing we're going to have you next year to tell us all about the choppy, volatile moves. Manisha, thank you very much for that. Get into a break. Up next, we'll talk about the IT space. Q1 numbers look good, but the commentary from the Accenture management has turned a bit cautious. Indian IT names are a bit subdued in trade. Aniket Pandey of ICICI Securities joins us next. Welcome back. Let's talk about Accenture, which reported their numbers on Friday, and the read-through for the Indian IT companies. As we've been highlighting, Accenture's Q1 numbers were very strong. Revenue growth at 15% is ahead of the company's own guidance. FY23 top-line growth guidance has also been maintained at 8 to 11%. which is fairly positive given the macro uncertainty that we're living in. But the way Street is reading it, that despite a strong Q1, the company has not upped its guidance, which basically tells you that they're expecting growth to decelerate in the second half of the year. What's the read-through for the Indian IT space? Aniket Pandey, the lead analyst of technology at ICICI Securities, now joins in. Aniket, morning. First, the top 3 takeaways and the impact on Indian IT.
Hi, Rima, morning. So basically, the first impact would be the kind of revenue growth slowdown which Accenture is building up into the second half of its year, right? In second half of FY22, Accenture almost did a revenue growth of around 25% YOY on CC levels. And in second half of FY23, we are seeing the revenue growth guidance just implying a growth of around 5.6 to 9.6% on a YOY CC basis. Okay. Second is, Rima, since last 3 quarters only Accenture, before prior to 3 quarters, Accenture used to hire around 50 to 55,000 of employee per quarter. So since last 3 quarters only, we have seen massive moderation in employee hiring only. And now employee hiring just stands at around 10,000 to 11,000 levels. Pre-COVID, the employee hiring was between at around 7 to 8,000 level. Okay. The third indicator would be there is a clear slowdown into discretionary revenue also of Accenture actually. As you know, Accenture gives revenue growth of managed services, which is outsourcing, and then there is its consulting business. Okay. So this time the consulting growth also was quite softer actually. I mean, since last 4 quarters, consulting growth was between 25 to 32%. And this quarter it has just moderated to around 10% on a YOY CC. Okay. Thirdly, for the first time, we saw a bit of caution coming in Accenture commentary also, like management have highlighted a weakness into retail, consumer good and CMT verticals also. Indian IT services companies also have called out weakness in this vertical. Okay. Fourth would be, this time they clearly mentioned that client focus is shifting more towards large cost transformation capabilities deal towards cost takeout deal actually. Okay. So that is one positive tailwind for large cap Indian IT players as these guys have higher market share into cost takeout deals.
All right. Hi, Aniket. Good morning and thanks for joining us. So, you were talking about the revenue moderation. They're sort of building up for a slower H2. Do you think that this is pretty much a theme that we're going to see across the sector, or is it a little bit more divided with the larger IT companies versus the smaller ones? How do you expect that to pan out?
No, actually, this would be similar to almost all the entire pack actually. Okay. Because you are seeing weakness coming into software and SaaS player also. Okay, so basically, if you look at the cloud capex also, right? So cloud capex can be considered as a lead indicator of future cloud migration demand. Okay, in this Q3 CY22, basically, consensus estimates for Microsoft and Google were at around 7 to 5% below the expected cloud capex actually. Okay, so we are clearly seeing moderation in cloud capex. Secondly, this time for the third quarter consecutively, the cloud revenue growth of hyperscalers have moderated again. Okay, so going forward now from here on, there is entire softness which is already coming up into SaaS player in US and also into cloud capex player and also into hyperscalers. Okay. I think this is all going to reflect on Indian IT services also.
Aniket, wanted to get your thoughts on the price action we could see in Indian IT space. I believe your view is that the Indian IT companies' performance, financial performance and commentary is likely to weaken over the next 2 quarters. Tell us what your hypothesis is. What's the extent of earnings downgrades or PE rating we could see? And what's the best way? Is right now IT a complete avoid and wait for an entry point, perhaps 6 months down the line?
Sure. So my sense is, Rima, from this quarter onwards, you will see management commentary more weakening as compared to earlier quarter. Like last quarter, all managements were just highlighting weakness into its retail vertical. Okay. Now from here on, retail, CMT, manufacturing, a bit of BFSI also weakening will start on actually. Okay. And the impact on revenue growth, Rima, would be visible in Q1 and Q2 of FY24. Okay. So that is on revenue front actually. And as you are well aware that Indian IT stocks multiples are more sensitive to revenue growth as compared to its EPS growth. Okay. Second thought, sorry, second.
Wanted to get your thoughts in on the price action. Are we likely to see a sharp correction in IT names, the extent of earnings downgrade, and is there more PED rating in store?
Rima, right now Nifty IT index is trading at around 22.5 times.
Okay.
So this is still trading at around 35 to 40% higher than its pre-COVID multiples. Okay. Your revenue growth is nearing to about pre-COVID levels from next year onwards. Okay. Your margins are already below pre-COVID levels. Okay. Secondly, Rima, there is not just weakness coming into large deal wins actually. Okay. There is also weakness coming into shorter deals also. Right. So in last 5 to 6 quarters, all these IT companies have massive market share gains where every enterprises wanted to focus aggressively on B2C spends actually. Okay. Which were creating a lot of small deals on the table. Okay. Now that delta from those small deals also would not be visible, and neither from the large transformation deals would be visible. Okay. The delta mostly will come from cost optimization and cost takeout deal. Okay. But let me tell you, these deals are generally lower margin in nature. Okay, so my sense is that still according to my revenue estimates are completely factoring US recessionary environment. We are not expecting a soft landing in US in FY24. Okay, so let's take example. My revenue estimates for Infosys stands at around 7.5% USD dollars actually. Okay, and when it comes to margin, Rima, now as you are seeing complete moderation in demand happening, there is supply side pressures are completely waning off now. Okay, so from here on, you won't see any big margin headwinds coming on to the IT stocks, which will also reduce the EPS cut actually. Okay, so yes, there would be cuts coming into revenue growth estimates, but flowing down to EPS, according to me, the cuts would be far more lesser as what we saw in last 4 quarters. Okay, so I think still 5 to 6% EPS cut would be there in this sector from.
Welcome back. You're still tuned into Trading Hour. Like we've been telling you, for the market, it's looking quite steady, around 85 points higher right now. By the way, Bharti Airtel launches 5G services in Shimla. Okay, so some updates coming in. It is the top gainer on the Nifty as well, so do keep your eye out on that one. So the market is holding quite steady, but it is the mid-cap index that we have seen, rising significantly in the past 20 minutes or so. In fact, take a look at some of the larger auto names, because that is what has also led the frontline index higher. So the likes of Eicher, you have M&M, you have Maruti, all at the high point of the day. A lot of the banks have also been moving higher while we've been talking. So something like an ICICI Bank, you have Axis Bank, all of these at the high point of the day as well. So let's get your technical check on the market right now. Kush Bora joins us for exactly that. Kush, good morning and thanks for joining us. We did see that dip right at the open, but ever since then we have been trending higher. The mid-cap index also holding up quite well right now. Would you take a call on it just at the index level today?
Sure, Pavitra. First up, thank you for having me on the show. Well, the in-the-money put options and at-the-money put options were showing, signs of addition on Friday as well. And we're seeing that continued today as well. So I think in the medium term or the short term, the Nifty could see a bit of a positive bias, but it'll still be range bound because, that's where 18,400, 18,500 call options are also seeing, a bit of writing. So I would think that, Nifty with a positive bias, but a range of about 100 points or so. Bank Nifty, on the other hand, has taken a much needed, well-deserved break, last week, where it saw a weekly decline after about 10 weeks or so. Now it's ready for its next run. So I'd be positive on Bank Nifty. That's where you go. You can go long. 43,200 would be my stop loss. 43,700, 43,800 zones is what I'll be playing for on the Bank Nifty.
What about stocks, Kush?
Sure, Rima. Since I am so gung-ho on Bank Nifty, the first pick is from the banking space, and that to the big ones, which is SBI. We've seen a fair bit of dip in the stock, but it's holding on to 600 levels fairly neatly. I would suppose that this level will hold on. Even the put writing data suggests that. So 595 is where my stop loss would be, and 625 is my target. The second one is from the metal space, which is Hindalco. Again, the metal space has been seeing a bit of a up move ever since the July-August series. This stock has been making a series of higher lows, so which is indicating strength in the stock. I'd be long on this stock for a target of 475. My stop loss would be a very close one, which is 455.
All right, Hindalco and SBI are your two stock picks. Kush, thanks a lot for joining us and taking us through those individual trades. We have to get into a short break now, but on the other side, we're going to discuss the fundamentals of this market. Devang Mehta of Centrum Wealth Management.
Let's talk about markets. Devang Mehta, the head of equity advisory at Centrum Wealth Management, is now with us on the show. Devang, for the last couple of days, it's been all about these sugar and fertilizer names where we are seeing the maximum momentum and excitement. Any thoughts on these two spaces?
Afternoon, Rima. I think what is happening is probably market is taking a pause. We have seen globally also sort of a little bit of volatility again creeping back after the Fed stance was a bit hawkish, and we saw a lot of central banks sort of raising rates and still scared about inflation. And also on the other side, it's also a scare about recession, which is sort of driving the market trends at this point of time. So I think India, after a smart rally, is getting into hibernation mode where consolidation can happen in the larger names. As such, a lot of Nifty stocks, a lot of companies which are frontline have rallied a little too ahead of expectations. I think the second leg of the market rally is going to be driven by companies which have been laggards, companies which have not done very well, but they've opened up in terms of earnings opening up or cyclicality. Deep. A lot of these companies which we discussed about fertilizers as well as sugar had gone through a deep period of cyclical pain. I think those companies are coming back. The market breadth as such is not bad. A lot of companies in the mid-cap, small-cap universe and companies in the sectors which have not done well is coming out. So particularly view on fertilizers as well as sugar is a little different for us. We generally don't chase this type of businesses for clients who are long-term. Yes, for shorter-term, medium-term, there seems to be a trend which is emerging in this type of companies. But pure play long-term, we would be more positive on something like agrochemicals, specialty chemicals, which also go through cyclicality. But there is a lot more money to be made as China plus one, Russia plus one theme plays out, and India gets into that competitive edge period as well.
Hi Devang, good morning. You were just mentioning that, a lot of these stocks actually ran ahead of themselves and perhaps are now correcting. Take us through which ones you're referring to here. Are you talking about the banks?
Yeah, Pavitra, I think banks had a big period of underperformance. Let's be very clear. A lot private banks started to rally first, the likes of ICICI, the likes of Axis, they rallied first, and post that, a lot of PSU banks also. There was a 10-year underperformance clearly on SBI. If you look at the last 10-year returns for SBI, hardly the last 1.5 years has been where money has been made in this company. So somebody who waits on these businesses for the next 3-5 years, it's a difficult proposition when your companies do well. You sort of want to buy companies which do well. So you feel left out. The sense one gets here is if somebody has a 3-5 year horizon and is focusing more on compounded annual growth rate or IRR, still private banks are the place to go. But yes, for the 6-month, 1-year period when your NPAs are all out of the system, when your NIMs are going to expand, you can't lose out also on certain PSU banks. And that's the trade which is getting taken at this point. Autos had underperformed. Most of the auto and auto ancillary stocks have also started to come to the fore and do well. And as the first question was regarding fertilizers, a lot of PSUs, a lot of sugar companies, all this had a long period of underperformance, including power stocks as well. So most of these companies are sort of getting maybe some fundamental cushion ahead, and some are a rally of laggards which we are looking at this point of time.
So your top 3 bets for the first half of 2023, Devang?
I think on a sector perspective, yes, I'll give certain examples as well. But on the sector perspective, typically your banks look exceedingly well. Banks look very good. Particularly ICICI and Axis Bank. Of course, these companies had rallied, but over the last 2-3 months, most of these companies have consolidated. I think the management commentaries for the coming quarter, the January quarter, is when the domestic earnings season will start. And again, most of the management commentaries will point out towards consumption probably expanding. Discretionary was good. Non-discretionary started to see some bit of green shoots. Capex is also on the rise, and credit growth is also going to come back to the banking system, which is around 17-18%. So my sense is you can't miss out on banks. Top private banks will be the first pick. Second is discretionary consumption, luxury consumption. Companies like Titan also seem to be probably consolidating in the last 3-6 months. They also can sort of come up with good set of numbers, being festive demand, being wedding demand. I think all this will also come to the fore. Importantly, one sector which we have been always bullish at the expense of being repetitive is home improvement or sort of building materials, where we are also seeing crude coming down drastically from say 130, 120 to sub 85, sub 80 in the last 1 month. Very importantly, most of these companies had inventories, and that's why the last quarter numbers were not so good. So maybe this quarter or next quarter, the numbers would start to improve drastically, and margins will also show a good bit of expansion. So my sense is that somebody want to play a 1-2 year theme in consumption, in building materials as a real estate cycle, a proxy play for paints, adhesives, electrical goods would do very well.
All right, got that. And would you directly play the real estate companies, by the way, since we're talking about home improvement?
I think some of them look interesting, but as I said, a direct play on them would be a little risky because we know that how much they book in a quarter, that's always a little volatile game to play. But most of the proxy plays or the ancillary play, you are very certain that these companies would have a strong cash flow. A lot of these companies would also have a negative working capital cycle. Most of these companies show pricing power. So I think that part is a little more attractive to us than getting into real estate, direct real estate.
Dr. Naresh Trehan of Medanta says Cleveland Clinic is his inspiration. Healthcare is a business with a soul, and medicine-first attitude will give good returns. Talking to Ekta Batra at his flagship hospital, Medanta Medicity in Gurugram, he says the focus is to make healthcare as reasonable as possible. Here's a slice of that conversation.
By principle, we do not want to be the most expensive in the market, no matter how high our facilities are. We want to make it as reasonable as possible, keeping in mind that as many people who can access this kind of treatment should benefit. It should not be for the elite. So if you look at our mix, we have all people, the highest people you can talk about in your hierarchy. I don't consider them high or low, but I'm saying that at all economic strata, all educational strata, government, all that stuff, we are agnostic. We want to give the same treatment to everybody because human life is the same, no matter where you come from. So we try to keep it as affordable, keeping in mind that you need a certain margin to be able to, one, renew yourself, which is very important because technology is the backbone, and technology gets obsolete within 7 years. This whole 20-25 crore machines, the company says end of life. I mean, these are bizarre things that have happened, but we are in the clutches of international manufacturers. Of course, with this Atmanirbhar, things are improving. We will, in times to come, produce our own MRIs and high-end scans and stuff like that, which we don't today. So we are totally dependent on these companies from around, and they can dictate. They said after 10 years, although the machine can be extended to longer, much longer, maybe 15 years, 20 years, some of the machines, but they refuse to give parts. They say, well, now we don't manufacture parts anymore. So you have no choice. So I'm saying that you have to keep it in mind that the pricing has to give enough that you can renew yourself, you can pay back your debts, and also leave enough margin for growth. So putting this together, I think that around 20 to 25% is the ideal margin which you should have in healthcare, because it's, like I always say, it's not a business, it's a business with a soul. It doesn't have, it's not cold-blooded in any way, it should never be. So for us, medicine first, because I have said it many times, that good medicine will give you good returns, but good business will not give you. So that's the whole.
So will the margins probably sustain at 20%? You've done 20% in the previous quarter. Is that the target?
No, I mean, if it goes up 2, 3, 4%, this is not bad. This is good. It only gives us enough elbow room to create more. But you don't want to cut corners. You never want to compromise the quality of treatment. You do not, and like I said, you don't want to deny people. Because, people who are already on the sidelines, okay, they deserve medicine as much as anybody does. So you try to make it possible in whatever way, how. Now you see, the government has also taken that view with Ayushman coming in. There is the relief, there's a safety net for 50 crore people. And now the government is also talking about increasing that net, and how it should be. People who can afford should buy private insurance. People who can't afford should be given this kind of safety net, which the government has done.
Correct. The payer mix, that brings me to the payer mix since you mentioned government. How much do you probably get in terms of, say, institutions or government-related institutions in terms of payments? And what are the receivables as well? Because many hospitals are actually looking to reduce the percentage that they get from the government or institutions.
I don't think that's the right approach. The approach is that you offer your services at a level that people who can afford and have private insurance, that number increases. But you don't have to deliberately reduce the number of people you're going to service because they are in the government. No, they also, see, how do you recognize the contribution of anybody or everybody to the country, to the environment, okay? Believe it, India, with the diversity that we have, held together for 75 years is a major accomplishment. You know what's happening to all our neighbors. They're all falling apart. So, who all have contributed to that? Basically, the bedrock of ours has been the bureaucracy.
All right, that was a piece from a very special series that we have planned for you, Medicine Box, a deep dive into the world of pharma and healthcare, where we'll get you snippets of this conversation all through the day. So remember, you can catch the full conversation as well this week only on CNBC-TV18. Okay, with that, we have come to the end of the show. The market is seeing a 95-point gain. 18,365 is where we're at on the Nifty. The mid-cap index also holding well in the green after, seeing negative cuts for all of this morning. Right now, it is a near 90-point gain that we are seeing on the mid-cap index. So definitely in positive territory now. We're going to wind down in this edition of Trading Hour. You guys stay tuned. Halftime report comes up in 2.